I'm thrilled to kick off the day and kind of ground the day in this incredible panel, which is intended to get everyone up to speed on the latest state of play in the voluntary carbon market, which for the uninitiated, we will refer to as the VCM. It's been a dynamic, transformative, and dare I say, turbulent 12 to 18 months in the VCM. And so we're going to cover the major topics related to policy, standard setting, MRV, which is monitoring, reporting, and verification, ratings, trading, financing. In order to do this in a really comprehensive way, we put together a panel of really the leading organizations and thinkers and leaders across all of these different perspectives. And so with that, I'm going to briefly introduce our panelists and dive into some topics. So we have Alexia Kelly, who is the head of carbon policy and markets initiative at the Hightide Foundation, but that does not encompass everything that Alexia is. She is one of the leading voices and thinkers in the voluntary carbon market, involved in every key initiative in this market, including and in particular the ICVCM, as is the Hightide Foundation, and we're thrilled to have representation from the leadership of the Hightide Foundation here as well. So thank you, Alexia, for being here. We have Seb Cross, who's the co-founder and CIO at BeZero, which is, I'm sure many people know, is an essential ratings agency in the market. We have Sonia Battikh, who's the head of carbon offsets trading at Citi. We have Diego Saez-Gil, who's the founder and CEO of Pachama, which is a very innovative carbon project developer doing nature-based projects. And we have Joe Dell'Orfano, who is the relatively new CTO at Verra, which of course is the major, most essential standard setter and standards body in the carbon market. So a great set of perspectives. And with that, I will hand it over to Alexia. So Alexia, it has been a challenging, also exciting last 12 to 18 months in the VCM. Can you kind of give everyone a table set of what's been happening over the last while in the VCM? What's the state of play? What's happening? A recap, and especially as it pertains to policy and regulation.
Thanks so much, Dana, and happy Climate Week, everybody. It's great to be here and appreciate the event and the lineup and the fabulous co-panelists. The thing about the carbon market is that it's never boring. It's been 20 years of change and progress and excitement. It's really, really wonderful to see so many new faces in this room and so many representatives from the financial markets and financial institutions here as well. Because this job of pricing carbon is the most important thing we can do in the low carbon economy transition. And that's what the carbon market does. It puts a price on carbon. And if you look at the history, particularly in markets where we have been unsuccessful in passing comprehensive and binding climate legislation, such as the United States, most regulatory systems and frameworks have come behind the work of the voluntary carbon market. And so in California in the early 2000s, as that market was getting established, it started with voluntary registries and nonprofits stepping in and saying, hey, we really think there's something to this job of trying to quantify and put a price on carbon. And somebody needs to figure out how to do this right. And we haven't always done it right, but we have learned an unbelievable amount over the last 20 years. And it's been the Hightide Foundation's real privilege and honor to be part of what I see as just a sea change in the evolution of the market through the work of many of the folks here in this room, and also through the work of the Integrity Council for Voluntary Carbon Markets. So for those of you who don't know the ICVCM, I think probably most of you do, but just as a reminder, it's a quasi-regulatory, non-governmental body that was established about 3 years ago in order to really look at all of the financial pieces of the market and make sure that those were starting to come into play, and also set a threshold quality benchmark from a governance perspective and from an underlying attribute perspective. So our CCP label, the Core Carbon Principle label, is intended to be the marker of that threshold quality across the market. And we've been working over the course of the last 3 years intensively to look at the existing carbon market, look at what's worked well, look at what hasn't worked well, and work through an approval process from the nearly 2,000 methodologies that are in existence globally. We're reviewing 100 of the biggest ones. So there's a two-tick process for the ICVCM. We have strong governance requirements that ensure that any standards that are approved as an ICVCM or CCP eligible program meet high governance and oversight integrity standards. And then we also have a set of core carbon principles that tell you that the environmental attribute that you're buying represents the best available science and is delivering real and meaningful impact to the atmosphere. It's been a really busy 3 years. It's been an incredibly intensive process to write that benchmark for quality and then work our way through this incredible, rich sort of diversity of approaches and methodologies that have been taken across the core carbon. Across the carbon market historically. So that process, we now have 5 of the major crediting programs approved from a governance perspective. We've reviewed about 33% of the market. Of that 33%, we've approved 3% for CCP eligible credits. We still have 70% to go though, and many of the major credit types that folks pay the most attention to, particularly around REDD+, improved forest management, and afforestation and reforestation, are coming next. So the label process is working, we're working systematically and as quickly as we possibly can to deliver those. They will be rolling out and coming in the next few months. And in addition to that, we've started what are called our continuous improvement work programs. And what the continuous improvement work programs do are really bring the market together to look forward. How can we work together around permanence and think about pan-market approaches to some of these key issues that we're grappling with collectively as we think about how to institutionalize and grow this market into its next phase of work. And that set of work is incredibly exciting and also very, very challenging, but has been deeply rewarding because the market's never had a place or an opportunity to really come together and say, you know what, this worked really well, this didn't work so well. We now have the information from the ratings agencies and all of the remote sensing data that just didn't exist before. We didn't have any of that stuff when we were doing this in 2010, writing these first methodologies. And so that process of coming together and saying what's worked well and how do we move forward is really the inflection point that the market is at right now. We've also had government come in a big way and in ways that we haven't seen them really stand up and say, hey, these markets are important. I actually had an interviewer call me on Friday, a reporter, and say, why is there so much conversation at Climate Week this year about carbon markets? And I said, because people know that carbon markets are not an optional part of the solution. They have to be part of the way in which we address this problem. And they're one of the most efficient and best mechanisms for getting money where it is to where it needs to go to frontline communities. So the indication from the White House and the US government with their high integrity principles that they've released in May, the pending CFTC decision that we're expecting, guidance that we're expecting here in just a little bit, and a lot of the market standardization that we're starting to see. So Expansive just released the first standardized contract and first exchange-traded CCP labeled credit in July of this year. So we're starting to see this work through the system and be taken up by the market more broadly, but it's not happening as quickly as we would like it to, I know. So we thank everyone for the patience as we are really resetting so that we can move forward with full faith and confidence that this market is delivering the core environmental outcomes that we need it to be delivering, while also building that threshold infrastructure for market scale and integrity as we move forward.
Thank you so much for that. I think we got one of the essential sound bites of the day already, which is carbon markets are not optional. They're not an optional part of the solution set. Anyway, I think the other most important takeaway is the emphasis on quality that this market has seen over the last year. It has manifested as the CCP labeling out of the ICVCM. But Seb, I want to go over to you and talk about how BeZero, and especially as a ratings agency, has been brought to bear on qualifying, quantifying the quality of carbon credits in this market.
Absolutely. Thank you, Dana, for having us, and thank you, everyone, for being here. So for those of you who don't know BeZero, as has been introduced, we are a carbon rating agency. What does that actually mean? It means that we look at carbon credits and we look at the likelihood that they achieve a ton of carbon. So what rating is doing is telling you about the risk that carbon credits face. Quality is actually a slightly different concept because quality is subjective. My view of quality can be different to anyone here in the audience, but what we're trying to do is tell people about risk. And indeed, having rated almost 500 projects to date across all major sectors, all major accreditors, what our database of project ratings tells you is that risk really does sit at the project level. Every single project is different in this market, what makes it quite hard to navigate. But if you don't understand that risk, then you're not able to make informed decisions. And that's really, really important for how the market thinks about scaling. As Alexia has said, completely agree that the ICVCM is doing some fantastic work, the CCPs, in harmonizing the standards and particularly on the governance side to ensure that people have the confidence to even interact with the market. They know the minimum threshold of what they're getting. It's setting guardrails for the market. It doesn't mean that these things are now risk-free, unfortunately. There's still risk that exists, and so that's where ratings can then play a role, complementary to what the CCPs are doing. But this is really important then for how we think about the regulation of this market. Right? Regulation is really, really important. In a market that lacks trust, governments coming in and saying how they'd like people to act and indeed imposing maybe stricter regulation in the future is a really good signal for giving people the confidence to actually engage with this market and for it to scale. But the concept of risk needs to be part of that conversation. You cannot get rid of risk by setting top-down factors such as the methodology type, such as the accreditor. You need people to take account of the risk that exists at the project level. And that's what we're doing with the ratings, and we've seen that be adopted in the market. We make our ratings publicly available. Anyone can go onto our website and access them because we think that language of risk that this represents should be available to everyone. And should be used in every decision that's being made across the market. And so it's quite exciting from my perspective, having not been in carbon markets for the last 20 years, but certainly having looked at the history of carbon markets, particularly I come from a financial markets background. One of the reasons that this market struggled in the past is it hasn't taken account of that risk. And it's meant that when there's an issue with a given credit or a given project, it leads to a crisis of confidence in all credits because people don't know how to disentangle that risk. That's different this time round. I think that's a fantastic base to be building a sustainable market off of.
Excellent. And I think this work of the ICVCM and BeZero in creating standardized risk assessment frameworks is so that the major institutions globally can participate in this market. And so I'm really thrilled to have Sonia here, who represents one of those organizations, Citi. So Sonia, as someone leading carbon offsets trading at a global financial institution, what role do you see a bank playing within this market? What are the key challenges in having a bank funnel financing to these projects?
So thank you, Dana, and lovely meeting you, everyone. Thanks for having me. So, as you mentioned, Alexia, carbon offset market is not new, and it's been going on for 20 years. But over the last decade, I've seen a big change on, before I remember, we were talking about carbon offset, people said, okay, what it is. No, you go in the street, everyone knows what's carbon offset. So it's actually a positive sign. It's like people know what it is. And we've seen quite a lot of shift as well of the, before some company was wondering, can I use carbon offset, how I'm going to be perceived? So that's moved as well. People recognize that a voluntary carbon credit is not a plus, is needed, hopefully for an interim solution that is as short as possible, but is clearly needed right now. Now, what a bank is doing, so we fairly, I will say, relatively new at Citi, at least on the voluntary carbon market. We've done compliance market for quite a long time. But the last 3 years, what we've developed is really, we don't want to be like a bank where we are a broker, where we buy on the secondary market and we sell to a client, because I will not have any added value for client. So what we see as a role of a bank is really to have a hand-to-hand business approach. And by that, I mean, we're sourcing project directly, structuring financing, assessing the project, and obviously with our presence in 92 or more countries, we have a presence there. We can go on site and visit. And then we structure financing, which is a role of a bank, of taking that and offering to our end user. Now, we don't need to reinvent the role of a bank. A bank is ready to channel the financing for the capital market, choose a project, and then offering to our end user. Now, another thing as well is that our end user more often, before it was more a spot market, and we see that actually more often now we have a request for long-term forward purchase. And obviously, it's quite difficult for some corporate to face the project directly, given obviously the credit risk. So having Citi as a counterparty help. But for a project developer, it's quite difficult for them to assess the financing. And again, so the role of a bank like Citi is really to structure that financing, to channel that to the project developer in order to get them access to that financing that they will not otherwise have.
Excellent. You happen to be sitting next to a great project developer. And so, Diego, I'd love to hear if you have anything to say about financing and how that journey has gone for you. But you also are a leading pioneer project developer leveraging new technology like AI, like satellite imagery, to increase awareness and quantification and MRV, again, measurement, reporting, and verification of the carbon emissions that you're sequestering in your projects. Can you talk about how that's been, how it's been incorporated into some of the broader methodologies and been brought to bear on the credits that you're selling?
That's right. Thank you for having me. And yes, we started Pachama 6 years ago with the insight that certain technologies were advancing exponentially, such as satellite data, AI, and just connectivity around the world, which was going to allow a new vision, a new transparency that was impossible before, as Alexia said before. And we want to put these technologies at the service of making it easier for companies to diligence projects, for projects to come up with their own accounting, selecting land, estimating the carbon sequestration that they're going to produce in a way that could be faster, cheaper, and better. And we've been working on those technologies for 6 years with great progress. Now there are many groups working on what is today called DMRV, Digital Monitoring, Verification, and Reporting. And it's really bringing a new generation of projects to the market at a moment in which integrity is critical. And we see the evolution of the market from projects that could issue credits right away to projects that will issue credits over a long period of time that sometimes have a gap of financing that need upfront capital to get started. And there is a beginning of transactions that involve corporations committing to purchase and pay on delivery, offtake agreements. And then that gives the opportunity for financial players to come in and invest on those projects, knowing that they can get a return. We recently announced a partnership with Patria, which is the largest private equity firm in Brazil, to invest in reforestation projects in Brazil and Latin America. And we see that as just one example of many new initiatives that are emerging on the market. And definitely it's been a turbulent last 18 months. I think that the market was with great momentum, and like it happens in many industries, there is sometimes an overhyping and a crash, and then a valley of disillusionment, and then the growth to the true promise of a framework or an idea. I think that's where we're at today with the voluntary carbon market, going out of this valley of disillusionment into the true promise that we have, because we need to absolutely drive tens of billions, perhaps hundreds of billions of dollars into sequestering carbon to reach net zero, and corporations know that there is no way around it, and there is this new coming together around these new technologies, new financing frameworks, new deal making.
That's great. Thank you so much for that. And I think this, just so everyone's kind of aware, one of the probably two key questions in the VCM over the last 12 to 18 months has been around establishing standards for quality. The risk that we're all talking about, one of the key risks in the market is that a corporation or some end buyer is going to purchase a carbon credit, but then the quality of that credit is going to be called into question. The project from which the credit was generated is going to be called into question as not really producing the carbon benefits or impact that it claims to have. And so the market over the last 12 to 18 months has seen a really robust course correction in the form of the ICVCM CCP labeling, which is evaluating the project methodologies, in the form of ratings agencies that are coming in and evaluating projects at the project level, looking at what they're doing, giving them a rating, in the form of project developers themselves that are leveraging new technology to make sure that they're as meticulous and careful and transparent as possible in the quantification of carbon impact that they're reporting, so that institutional players like Citi can come in and help funnel institutional capital to it. And this all converges at the standard setter, like Verra, which is the largest and most active one in the market. So Joe, we're thrilled to have you. You're the relatively new CTO at Verra, the leading standard setter in the voluntary market, which actually issues these credits, evaluates the projects, issues the credits. So can you talk about your role and talk about how you're approaching leveraging these new technology solutions and other solutions to make sure that the credits that you're issuing are as trustworthy and high integrity as possible?
Yeah, absolutely, and thank you, Dana. And I am really honored today to present or represent Verra and with this distinguished committee here. So by a show of hands, how many of you know Verra? All right, awesome.
Wow.
So almost the whole room. That is fantastic. So as Dana alluded to, we are the largest nonprofit standard setter in the market. We work with our project proponents and developers with our methodologies. There's over 90 methodologies, nature-based, energy, sustainable development, and others. And that has resulted into over 2,200 active projects in 95 countries across the world. So pretty fantastic if you think about the financing that's going into the carbon ecosystem as a result of the great work that Verra has done historically. But as we've alluded to today, right, there's some underpinning things that we need to work on to increase trust, transparency, and the integrity in the market. And my role here at Verra as CTO, Chief Technology Officer, is really to work across our business lines and drive what we're calling our digital revolution. I'm thrilled to have that opportunity. And so what does that mean? So really, we're looking across our different business processes. If you're a project proponent or a developer, you'll probably tell me today that while we have the greatest standards in the world, our process takes too long. Yeah, I heard maybe there's some acknowledgement of that. And so what we're doing is leveraging technology to hopefully improve that posture. So recently, and by story, so my experience is from insurance, retail, and restaurant industry, and lots of experience migrating legacy systems. Well, let's talk about our legacy systems here. Paper, Word documents, and PDFs. So we don't have the burden of a legacy system migration, but we need to introduce digital technologies. And I think what comes along with that is change management, both for our stakeholders as well as our internal staff. And so we're taking an incremental approach. Recently, we've launched our Project Hub. So it's an online portal for our project proponents and developers to come to Verra and interact with us. We're digitizing what was formerly manual forms and other aspects of the process. We have internal tools around, like our project location review tool. So leveraging insights, we can understand, are there projects that have overlapping boundaries? And if so, we can correct that before somebody tells us otherwise. We're working on understanding the buffer pool, and we have what we're calling our long-term monitoring system to really understand forest degradation as one example, and then being able to make adjustments to the buffer pool as appropriate. And then I'm thrilled to share, we've recently launched our digital project submission tool. We've launched our first 6 methodologies. And if you want to learn more about it, catch me after the session today. But basically, a project proponent and developer can go into our system, enter all of the project data electronically, not through pencil, not through pen, or Word document or PDF. And we've added the ability to calculate ERRs, emission reductions or removals, through our calculation engine. I think it's pretty outstanding and definitely something that we're trying to accelerate and get more of our methodologies online. And then partnering with organizations like Pachama is the future vision is through technologies like DMRV, leveraging sensor data, satellite data. A lot of this is now publicly available. Is that if we have that data from the start, we can enter that data right into our digital project submission tool and really take a lot of the manual steps out of the process. So really excited. Please visit our booth, and we're happy to share more insights throughout the week.
Excellent. So we have all of these different organizations taking all kinds of different approaches to ensuring the integrity and the quality of carbon credits in the market. And so now we can talk about how we get these projects financed, which is the key question that Flowcarbon is engaged in, day out on behalf of clients. And so Seb, I'll start with you. Building on sort of the investment discussion that we started having, how does BeZero's approach to risk management and to ratings help facilitate funneling institutional capital into this market?
Yeah, so this has been the exciting part of the ratings adoption that we've seen in the last 12 months or so has been the use cases that you're seeing of the rating. And if you look at what the rating does, it doesn't just give you a one-off risk assessment. All our ratings are live. It tells you about risk in a close to real-time basis. We have a team of geospatial analysts bringing in data from a number of sources to track what's happening on the ground with projects. But increasingly, we're being brought in right at the very early stages of project development when projects are being designed, because people want to take the rating and the ratings framework into account when they're thinking about project design in order to optimize around it. Now, why is this happening? Firstly, from a developer's perspective, we've seen the emergence of a correlation between our rating and pricing in the market. So developers now have an economic incentive to want to develop more highly rated projects, which is fantastic. But not just that, in terms of the actual risk management element, it's our point of bringing institutional capital into the market, or indeed bringing large offtake agreements in. If you look at the time frame that you're signing up to with these agreements, it's a long-term commitment, and so understanding risk is a key part of that decision, and that's something that the rating can do. It can plug into that decision and help you do that. But as I say, it's not just as a one-off exercise. It allows you to then track the development of the project, its implementation through to the issuance of credits and the subsequent, those credits being taken to market. And so what we've actually started seeing now is the rating being written into contracts as a way for both sides to align incentives so that an investor can be assured that the investment is being appropriately managed, so that an off-taker can be assured that the quality or the risk of the credits that are being delivered are such as is being promised. This is exactly how we see ratings being used in other markets, and it's really exciting to see it being used in this market, because I think it will help to unlock the capital that we need to see. Yeah,
I totally agree. Sonia, talking from the institutional standpoint, are there specific examples of innovative financing solutions that have already been developed or deployed into carbon projects?
Yeah, actually, so thanks for this question. What we realize is that, as I mentioned before, that now we've seen the market a little bit shift in terms of recognition of voluntary carbon credit and what they use it. And we've seen actually a lot of players, investors that wanted to invest in project, but actually cannot, because either they cannot face a project developer directly, or because they don't want the carbon credit, but they still want to invest. So we've developed a structure in partnership with the World Bank, which actually is a capital guarantee note. So in a normal note, the investor will invest. So let's take an example, like $50 million. And after 5 years, they receive, let's call it $7 million, whatever, depending on the interest rate. That would be kind of a normal note. Where here, what we're doing is that, so the investor still invests in the note, and the coupon is paid upfront to Citi. Citi will give it to the project developer, and once the project performs, which means that issue credit that is delivered to Citi, Citi pay the purchase price of the carbon credit, because obviously technically we haven't paid anything because it was the coupon from the World Bank that we paid. So then we pay back the price of the carbon credit to World Bank that pays the coupon. If the project failed to issue a carbon credit, then obviously Citi doesn't pay anything to World Bank, and World Bank pay back the capital guarantee to the investor, but the investor lost the coupon. And essentially what was quite interesting is to find that the investor, we've done outcome bond before at Citi, but this one has been easy to place because the investor really likes the fact that it's capital guarantee, only the coupon is at risk. And then it helps them for the KPI to have financing is sustainability project. So that was really interesting for them. Now, for the investor, what was really interesting is that instead of having investment at an IRR of 15 or 20%, because don't forget that mainly the project developer usually are a low balance sheet, and when they go for lending facilities, the IRR required is quite important. Where here is like 4 or 5%, I mean, depending who is the issuer, and that will be this, nothing else. And then another element is that if the project, you know, everything that was supposed to do, but for any reason there is an eligibility issue, or like Verra, for instance, cannot approve the project and the credit is not issued, they don't have to refund. You know, it's kind of a project risk that the investor is happy to take just for the coupon. And essentially, this structure have been, so we've done two. We have done one in plastic credit and one in carbon, and it's been replicated by HSBC, by K-Bank, and quite a few, and we hope it will be replicated a lot, because we can see that actually there is a lot of financing available now to go to this project, obviously much more than Citi can cope, and we hope that this kind of structure will be replicated as much as possible to channel the financing to the project developer.
Thank you. Alexia, what do you think is the most important development or change needed in the market to catalyze more investment?
Well, I've been told that you need both supply and demand to make a market work. And so I think one of the big challenges in front of us this year is aligning around what high integrity demand looks like for voluntary corporate purchasers. This has been a real pain point for the space over the last several years, and what we need to do is find a path forward that enables companies who are leading and taking voluntary action and start to counteract some of these myths that if you participate in the carbon market as a voluntary buyer, you're greenwashing. So what we find is that companies who are purchasing carbon credits and participating in carbon markets are actually climate leaders. They're decarbonizing 3 times faster. They're 3.5 times more likely to have a science-based target. And if we were able to get the world's 1,700 largest companies to address even 10% of their greenhouse gas inventory with high integrity credits, we could mobilize an additional $1.7 billion in the next few years. And so there's a tremendous prize at the end of this tunnel if we can find a way through for the environmental community to say, yes, this is what high integrity demand looks like. I think it's also important to pay attention to what's happening in the regulatory space around green claims and the work that's happening in California. So in 2023, California passed landmark legislation that will bring additional transparency to purchasing and sale of carbon credits. So that bill now requires public disclosure of information that hadn't been required to be disclosed publicly. So as we bring both the transparency and integrity on the supply side, we also need to bring that transparency and integrity on the demand side and work towards a shared understanding of what high integrity utilization of qualified high quality carbon credits looks like in the net zero economy transition. Because while we need to continue to push companies to do that hard work of decarbonizing their supply chains, we also need to mobilize trillions of dollars to stabilize the global atmospheric concentrations of CO2 and engage in the critical and urgent ecosystem restoration that's going to be required if we're going to keep this planet habitable, particularly for vulnerable and frontline communities. And so we have an obligation, I feel, as policymakers to make sure that we are balancing both of those objectives in a way that enables us to make meaningful progress across all of those fronts in the next 10 years. We can absolutely do it. It's just going to take some fancy footwork, I think, between now and then to get folks to agree around what the right construct looks like.
Do you feel like there's actually momentum towards establishing frameworks for high integrity demand in this market?
Absolutely. So if you look at the work of the Voluntary Carbon Markets Integrity Initiative, you look at ISO, which is establishing a new global threshold standard for net zero, which will be very important to watch because obviously, you go and you talk to a CFO at a major Fortune 500 about the SBTI and they look at you like, huh? But if you talk to them about ISO, they say, oh, I know ISO. I'm comfortable with ISO. So we're optimistic that ISO will be able to help us navigate through this, and their goal is to have a draft standard by Baku. The Voluntary Carbon Markets Integrity Initiative has been working hard to find an additional claim that enables utilization of carbon credits that companies will be excited and feel comfortable to use. And I think there's increasing recognition and convergence around the notion that it's okay to have multiple ways to take voluntary action. There is not one perfect one-size-fits-all solution for companies. And so having a variety of pathways and standards out there is actually beneficial from a climate impact perspective, not detrimental. So I see lots of progress coming soon.
Excellent. That's a very positive and optimistic outlook, and I agree. I feel that momentum also towards establishing standards on the demand side of the market that'll allow them to engage in this market in a high-quality way. We have a supplier here with us on stage. So Diego, how do you feel about the demand side of the market? You have a unique vantage point on this. Please share with the audience how it's been going.
Yeah, and while we develop some projects ourselves, we actually have been working with many corporations, Fortune 500 companies, on diligencing and investing in many projects, many project developers around the world. We've been helping many project developers around the world get investment ready. So we have a really good sample of both the demand and the supply. We see ourselves more as a technology platform to help corporations and projects deal with trust. And what we saw on the demand in recent years is, in one hand, you still have corporations purchasing carbon credits and retiring them as part of their short-term claims, and that's something that, of course, we need to continue fostering. We need existing project developers to be able to succeed on their projects that they have underway and to be able to reinvest in new generations of projects. Existing project developers have the capabilities, have the boots on the ground and the knowledge to develop new projects with the new standards, with the new methodologies. The second thing that we see corporations do is some companies are going and saying, okay, we are going to invest directly into projects. We're going to get very involved, sponsor these projects. We, for example, work with Mercado Libre, largest technology company in Latin America. They've been investing upfront in projects in a very forward-looking way, very inspiring for the region and for the world. And then the third thing that we're seeing is what I mentioned before, is corporations saying, okay, I am going to plan or forecast what is my upcoming demand of carbon. And by the way, we're seeing technology companies reforecasting with AI and an increased demand for energy that they see is not going to be able to be fulfilled with clean energy in the short term. So they're forecasting their next 40 years of emissions. They're saying this is the carbon sequestration that we're going to need to compensate this, that we cannot abate. And they're going and doing offtake agreements with projects where they commit to purchase at a price that they expect is going to be convenient to commit today. And then, of course, if you have a contract that says that a Fortune 500 company is going to pay a price if you deliver an asset of a certain quality, that is a very bankable contract where you can go then to a bank or to different institutions that are willing to invest on those projects, knowing that they're going to get a valuable ROI. So, yeah, we're seeing this new demand that is coming. We see the largest companies in the world being the scope 1 and 2, but then having a scope 3 that they're pulling behind, and we think that that is going to be very impactful on the demand side.
Excellent. Yes. Joe, hello. Can you talk about how Verra views its role in catalyzing investment into the space?
Yeah, absolutely. And the great thing about Verra is we have a very entrepreneurial spirit and drive innovation. It's part of our DNA. And so, right, to get to quality and integrity, we're looking at our methodologies, So for instance, we've invested significantly in jurisdictional data around our RED methodology. You mentioned Scope 3. We're really the one standard setter that is investing in Scope 3. We're going to roll out a new SD Vista, cook stove, and rice methodologies before the end of the year, which is fantastic. And so those, in combination with Abacus labels and hopefully ICVCM, CCP labels, we'll really be able to differentiate ourselves and demonstrate that we can get to high integrity, high quality carbon credits. Then the other thing is from a technology perspective, it's really kind of bringing a customer first approach to our business. So really understanding the needs of our project proponents and developers. We're leveraging AI and using sentiment analysis to kind of understand where are we seeing problematic areas and being more proactive in addressing those. And then democratizing data. So having APIs available that others can plug into, and hopefully that opens and further facilitates, a broader market.
Thank you so much for that. And thank you very much to the panel. That concludes this discussion. If you want to ask any of the panelists questions, I encourage you to find them after this and ask them what you need. But I, for one, am leaving this conversation very hopeful about what 2025 and even the end of 24 brings for the carbon markets in terms of financing, in terms of standards for high quality credits on the supply side, and even for things that are in motion to catalyze more demand on the corporate side of the market. So thank you so much to all of you for being here. Thank you. Let's give a round of applause.